Good afternoon, everyone. Welcome to today's Wednesday market stream. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the U.S. dollar, look at gold, silver, and oil, and then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat, and I'll take a look at it as soon as I can. If you like what you see here, you can always follow me at Stock Darts on Twitter. You can find videos of my stuff here on YouTube at Stock Darts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas and names that I'm putting on watch lists, and just generally expanding on the thoughts that we go over this on these Wednesdays as far as how I'm trading the markets. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. Here's a look at the S&P 500 with the ETF SPY. We are doing pretty good. Markets continues to rally. We continue to run up into pretty strong levels of resistance, and not really sure where else we can go from here. We have FOMC today. That is probably going to have a decent impact on the markets, and we have several key earnings reports over the course of the next couple of days. Before we move into the actual ETF, let's go ahead and take a look at. First thing we'll do is we'll look at Wednesday. And as you can see, after the market today, we have Tesla, we have Microsoft, we have Facebook. And obviously a bunch of other names. So some interesting ones that kind of mean something nowadays, like TDOC, or see how Qualcomm does, and a couple others. And then, of course, on Thursday, as you just saw a second ago, we have, in the aftermarket, we have Apple and Amazon and Visa, which are all huge names that are going to be pretty important. And we also have United Airlines. It'll be interesting to see how the airlines continue to perform as we move forward and we start to see some guidance and other ideas that might be coming in as far as how they're going to be affected over the next few months. So there's a lot of potential impact on the markets, particularly on the Qs, as several of the big tech names that account for almost 50% of the NASDAQ 100 are reporting this week. And we had Google report last night, and they actually had a pretty good report. As you can see, they gapped higher, and the markets have followed suit. As you can see, we're up pretty decently across the board, not solely on the back of Google, but that was part of what's going on here. And generally speaking, the markets continue to perform very well, and the question now is how much longer can we keep this up, right? Because obviously the markets right now are anticipating us opening businesses back up and going back to work, and things going back to normal. But the truth is, even once we open, we've already had a substantial hit to our economy with being closed down for a month, and we're right back at levels that we basically have been trading at for the last couple of years. If we go ahead and take a look at a weekly chart, and as you can see, if you just discount the rally we had at the end of last year and the beginning of this year, we're basically right back to the highs that we've been trading at throughout most of 2018 and most of 2019. And so at this point, the stock market feels like we're right back in the same place that we were just last year. And I'm not so sure that's the case, but like I said last week, I'm not one to argue with the markets. If the markets feel like we should be here, then that's where we're supposed to be. Keep in mind, the stock market is not necessarily a gauge of our economy as much as it's a gauge of people's impression and what price they are willing to buy stocks at, or what price they are willing to expect these ETFs or these indices to be trading at. And that's really the key. That's always been the key when you trade a stock, is understanding that you're not actually trading. So if you buy a stock, you buy Google stock, it might feel like you're buying, or it's priced based off of how strong Google the company is, but in reality, a lot of it is based off the perception of how strong Google is and what price people are willing to pay for it. And so when you look at a chart, you're looking at human sentiment, and you're looking at what humans consider to be a fair value on an equity. So right now, we're expecting the market to basically keep recovering and move back to normal. And again, I kind of, to a certain extent, disagree with that, but I'm not going to argue with the markets. Now that being said, I'm not buying anything right now. I'm not going long at the moment, because regardless of whether the market wants to be here or not, the risk reward is just not in the favor of bulls right now. And I think that's really important to keep in mind, is that even if a market's going to go up or down, if your risk to reward ratio, if you don't have a good trading opportunity um, that presents itself, then you probably shouldn't be trading it, despite whether you think it's going to go up or down. I've seen a lot of times traders will look at a stock and it'll be trading 6 days in a row, and they'll say, well, it's really strong, I'm supposed to buy strength. And they don't realize that despite the fact that it's been strong for so long, there's always the chance that it's going to retrace at that moment as people take profits, and you end up putting yourself in a bad trade because of timing, not necessarily because you picked the wrong stock. And I think at this point, the timing is not right to go long. I think we are starting to reach a point where we're getting a little overextended. We're going to start hitting some major levels of resistance. And in my mind, at this point, we're better off looking at either looking for shorts or just waiting for a pullback if you really think that we are done dropping, and just waiting for a drop before you could go ahead and buy the dip and go ahead and trade to the long side. And we'll look at those different types of scenarios as we analyze the four major market ETFs. So, like I said, with the S&P 500 and with SPY, we are hitting a major level of resistance. There's always the chance that we push through 295 and try to test the 200-pair moving average, which would just be, just a little bit above that move, that range. And there's a decent chance that that's what happens. But overall, I expect this area between 295 and 301 or 300 to be a major level of resistance, and I do not expect us to push through this, or at least push through and hold, at least not in the initial attempt. We have another kind of signal of a squeeze going on. We had that when we were looking at it a couple of weeks ago. We were looking at this rising channel, which is typically not a very strong continuation pattern. We had a quick drop, but we've continued to kind of squeeze past that again. And at this point, I think, again, it shows that the bulls are starting to get a little antsy, and they're starting to chase the price action, and the bears have real little impact going on right now. But what typically happens when you have these kinds of price patterns is eventually you have too many weak hands in, and you don't have enough strong hands that are buying at value. And what I mean by that is a lot of times in these scenarios, you have the patient traders that wait for the drop back to support to go ahead and get long, and then you have the impatient traders that start chasing the price action as it continues to squeeze higher. And higher it squeezes, or the higher it drifts up, the more and more weak hands you have in there, which are more likely than not to be the first ones to abandon and have a quick drop back. So in my mind right now, we are starting to reach a point where we're reaching strong levels of resistance with what I consider to be probably the wrong type of participation, as we have more and more weak hands coming in. You can see volume continues to drip down as we make our way up there. And in my mind, we are ready for a pullback. Now, that may or may not happen. A lot is going to depend on the tone of the FOMC statement today. And like I said, more importantly also, the tone of the major earnings reports that we have coming today in the afternoon and tomorrow. For those of you that are unsure what to do, I think by Friday, we're going to have a much better gauge of how these markets are planning on behaving. And from there, we should have a much clearer picture of where we should go next. Now, if we pull back, there is the ideal scenario in which we just pull back down to 273 and retest our 50-pair moving average and our 20-pair moving average and continue to hold this level as support. Now, this is a pretty important level. We've discussed this recently and definitely over the last 2 or 3 weeks. This price stems all the way back from this area back in March 10th, March 11th, March 12th. This is when the NBA postponed their season, and most of the major sporting outlets or sporting leagues also did the same thing, and a lot of businesses followed suit. So this was a big key turning point in our economy, where once the NBA decided they were ready to shut down, a lot of people followed suit. That's when we really had an acceleration to the downside, and that's been a critical area to get back above. We've been able to get back above that over the last 2 or 3 weeks now, and at this point now, that should be what was a critical level of resistance should now become support. And so that's a pretty key area for us to hold up as support. And if we find support there, then I think it kind of advances the theory that the market is ready to move forward and is expecting us to open back up and slowly start to get our lives back to normal. And if that's the case, then we should expect us to bounce from there and make our way back higher. Now, there is a couple potential scenarios that could play out here. If we really want to go ahead and try to extrapolate towards the next month or so, there is still an opportunity, even if that plays out, for this to be a bearish play. Now, this is way ahead of what could possibly happen, so I'm not going to go ahead and say this is how it happens. But I just want you guys to be aware of all possible scenarios that might play out. So there's always a chance that we come back, and if we do, I think that this is the key area that we should find support, and we should definitely try to find some buyers here. If we do find buyers, well, we still need a strong bounce, right? We don't want a bounce that just comes up to this area around 287, because at that point, we start to develop what looks like a head and shoulders, right? And that might mean that we eventually roll right back over into the summer and head back lower if we find out that more businesses are not really opening or getting as many customers as they would expect. Now, it doesn't have to play out that way, of course. That's quite a lot of prediction on the market, and typically the market's not very easy to predict. So I'm not going to go ahead and say that's how it's going to happen. But that's a scenario that we should keep in mind just in case we do get something like this. Now, hopefully what we would get instead is that we come down, we find support around these two moving averages, and then instead we continue making our way upwards, right? We come up to the 200, we try to make our way back above 295, and we continue to build upwards. And possibly we don't even come all the way down there. Maybe we just do something like this, right? And in that case, then we have a little bit of a more bullish scenario. Again, I think still a scenario that's still inviting a stronger pullback, because we'll still be getting kind of stretched out, but something we could keep our eye on, right? So those are a couple possible scenarios that we want to see and see how they play out. This area around 286 is a very short-term level of support. I don't expect it to hold if we roll right back over, but keep that in mind. If we do get the stronger bullish scenario, then we're going to continue to climb upwards, and maybe that's the area. But to me, the key area of support is 276, 275, down to maybe 273.50. If we lose that, then we're probably going to head all the way back down into the low 260s, maybe 261 to 255, somewhere in that area. And at that point, we have a much different market, right? Because at that point, we have actually gone backwards. We've fallen back below that big turning point on March 11th, March 12th, and we're back well below the moving averages, the 50 and the 20. So if we do pull back this week, which I suspect we're due for a pullback, and I think the nature of that pullback is going to be important. That's kind of been the case over the course of the last month. Is every time we've had a pullback, we've actually had buyers step in very quickly. We had this drop here off of this really strong bounce, and it was only a 3-day drop before we made our way and came right back up above it. And then recently we had the same thing. We had a 3-day drop, and we climbed higher. So as long as we continue that pattern, it shows that the market is ready to kind of move forward. Again, it's very bold to expect the market to make its way back up to the prices we saw at the beginning of this year. But that's what it's trying to do. And what we really need to see is we need to see the sellers step in and really define whatever the ceiling is for our current range. And then once we have a real strong impact on selling, that's when we want to see if the bulls are still courageous enough to come in and step up and support this market. Because I think at this point we haven't had a strong enough test to really have the bulls get scared and see exactly where they are willing to trust the market. And I feel like that's really the next step right now, is once we find enough sellers to turn the market right back around, we want to make sure that we have a substantial area of support that we can consider as a basis or a floor for our trading range. Because I still think at the moment that we're not going to V-bounce back to highs. I think more than anything, what we've done is we've established that we found a good low, and we should probably trade sideways as we try to figure out what's going to happen into the summer. Because the truth is, even once we open up, there's still going to be people that are going to be hesitant to go back to, to fly, to go cross country, to go to the movie theaters, to go to sporting events. Until we have come up with a vaccine and we have really put this pandemic behind us, a lot of people are still going to be scared to go outdoors, and we're still going to see shrinking of our economy. And I think at the moment, the market is priced in like once we open, things are going to go right back to normal, and we're going to be in the same place that we were just before last Christmas. And I don't really think we're there, but we'll see. We'll see how it goes ahead and behaves. So I think those are the potential scenarios in the S&P 500 we want to concern ourselves with the most. I think the ideal scenario and the most likely scenario is that we come back and we test this area around 273, 274. And if that's the case, the nature of that bounce will dictate what we expect next. If we fall below that, then I think that's a negative, and I think that shows that the market is starting to anticipate more selling. And we'll see where we go from there with a major level of support in the low 250s, or the 260 to 255 or so. And if we continue to rally, well, I'm not going to participate. I'm going to wait because as far as I'm concerned, if we start to get up into the 300s, that only makes it more likely than not that we will have an eventual rollover, and that it will probably be swifter than if we just kind of take our medicine now and pull back and look for support here. Now, if we look at the Qs, we'll see a similar picture, but slightly different. And slightly different because we are already challenging the levels from earlier this year. A lot of tech names. Now again, the Qs, one of the issues with the Qs right now is that so much of it is weighted in basically the FANG stocks and Microsoft. And so the fact that they are all doing pretty well has propped up the Qs, but a lot of tech names in general have actually been performing well because this has been the area that has been the most insulated from our economy and from being quarantined and practicing social distancing, because of course a lot of the tech names revolve around us using the internet, right? So they haven't been hit as hard as the rest of our stock market. And as you can see, we are actually challenging pretty critical levels that we were trading at, and we found the support earlier this year. So again, I think that we're hitting very strong resistance levels and levels that we probably shouldn't be trading through. We have that on the S&P 500 with the range, the ceiling of the range from the last couple of years, and with the NASDAQ, we have it as this pretty critical level. And as you can see, this was when things really started to get ugly. When the pandemic first started, and we first started noticing it, and realizing it could affect our economy, we had this quick drop, and then you can see we tried to bounce and come right back above it, and when we failed is when we ultimately had the big move down. So it was also a critical level of support before we had the really big move, that last kind of gasp of our bull market before we turned around and started heading back south. And this is a very critical area. If we look at a weekly chart, and we see where we stand on the Qs versus what we've done in the past, you can see that relatively speaking, the NASDAQ is actually still pretty strongly above the range that we spent the last couple of years in, and is actually very close to those all-time highs and close to that peak that we had just earlier this year. Just looking at it, you can see that we're due for a pullback, right? This big strong move over the course of 4 or 5 weeks now, with very little as far as substantial price retracements go. It's more likely than not that we need to kind of come back and retrace and backfill some of this area. We moved through some pretty strong levels. This ceiling here around 187, we just busted right through. We busted right through this little area consolidation that we had at the end, or at last summer before we really took off, and we've made our way all the way, like I said, right back up to a very critical level that we used this year as support before we started to make our way up to new all-time highs. And again, at this point, you have to wonder: is the market really ready to trade at the levels that we were at in February and January this year? Probably not. And if not, then where do we move next, right? So you can see the series of rising wedges on the Qs, again showing that imbalance that I mentioned earlier, of buyers and sellers, where the buyers are just kind of chasing the price action higher. You can see yesterday we had a strong move down, and then today, off of the Google earnings report, we just kind of climbed higher. And we have reached a point here where the sellers are really not have much of an impact. But as more and more buyers chase the price action upwards, it sets us up for an opportunity where eventually they will kind of cave and drop, and that's what we're going to see next, more likely than not. And if that's the case, like I said, with the S&P 500, it's the nature of the drop that is important for us. Yanni, yes, I will go IWM. That is, I basically always go in order. I do the S&P 500, the NASDAQ, the Dow Jones, and then IWM. So I will definitely give you my thoughts on IWM, for sure. Okay? So, we've reached the point now where we're starting to hit pretty critical levels, and we have these rising wedges indicating weaker buyers coming in, right? And so, again, I think it leads to a stronger possibility of a drop. Now, it could be the opposite, right? It could be that there's just so much strength right now in the market that we try to push through that. If the FOMC says something the market likes, if we have earnings reports that, again, the market interprets as positive, then the NASDAQ will be the first area that will push through these levels of resistance, and will likely be the area that we see a continued rally in, right? So I think that's pretty important to keep in mind. Right now, my thought process is that we've hit levels of resistance and we're probably going to roll over, but I'm not going to jump in ahead of time. One of the things I've always said here is we're not really in the business of predicting where things are going to go. We're in the business of reacting to what the market does. Now, you want to have predictions in place, right? You want to have scenarios outlined so you understand how to react when the market does what it's supposed to do. But I'm not going to guess that the market's going down here and just enter a short today. I would wait to see how it reacts to these wedges, and I would look for an actual price signal telling me the market is rolling over. And if the market continues climbing upwards, well then I'll keep waiting because, again, I don't like the risk reward here. If we go long here, we don't really have a stop, right? Our stop is all the way down here at 200, and what's our upside? Are we looking for a move here to this 224? Are we actually looking for a move back to all-time highs? Because really, you need a move to all-time highs in order to have it worth our risk if we're risking a stop all the way down in 200s. And that's just for one-to-one risk. So at this point, the risk reward is just not there for us to look at plays to the long side. There may be isolated names that give you good risk reward, and if you want to go ahead and take those, that's fine. But generally speaking, most of the stocks that I follow are at resistance, and the ones that are not are the ones that I have no interest at all in going short, which are the names that are the ones that I feel are being punished severely by our current economic circumstances. No problem, Yanni, and glad to have you here. I hope you like what you see. If you do, you can always follow me on Twitter, and that's where I usually post when I'm going to stream and when I put stuff on my blog and all that. If you have any questions, feel free to ask. If you have a stock, not just IWM, but if you have any stock that you want me to look at, you can go ahead and put it in there. Once I cover the markets and look at some commodities, I usually look at chart requests and take a look at whatever other people are asking. So feel free to type that in as well if you like, okay? So now, as far as the Qs are concerned, what levels can we look at as support, right? If we do end up coming back, much like the S&P 500, I think that there's a pretty strong area of support here around the 20-period moving average. Now, you'll notice where the 20's already crossed back above the 50 and the 200, showing kind of more of the bullish nature of it. That March 11th to 12th critical point is way down here at 192, so we've kind of left that behind in the dust. And at this point, I would suspect that the NASDAQ, the key area to watch for support is 205 and possibly down to 201. I don't expect us to lose that, at least not on the initial pullback. I think that's a pretty key area on the strongest part of the market, and so I'd expect if there's going to be an index that's going to hold at these moving averages, it's going to be the NASDAQ. If we do lose that, well, then we're going to come right back down to 193, and at that point, I would say that's a pretty bearish development, and likely means the market still wants to even test possibly lower than that. So that's going to be a key. If you want to be bullish, if you want to buy a dip, then you don't want the NASDAQ to fall below 201, and probably not even. You probably want it to hold even above 205 personally, but at 201 I think is still fine. But if we lose 201, well then we're likely going to come down here, and at that point I'm a little bit less interested in just buying a dip, and I'd have to see exactly how the market's behaving before I really wanted to go ahead and readjust what I'm looking at. But that would be a pretty big change in character in the market compared to what we're seeing right now. And on the opposite end, if we continue higher, like I said, I have no interest in buying higher than this. I think the higher we go, the more likely that we will eventually have a more violent turnaround and a quicker move back down. So personally, I think that we probably need to drop here in order to shake out a lot of the weaker buyers that have been chasing the price action up to these levels and reach a point where we can come back and find value and let the buyers that are patient kind of start dictating again where this market is going, rather than the impatient ones that are the ones that are kind of buying at these price points. Now we look at the Dow Jones. We'll see a similar picture, a lot more similar to the S&P 500, in that here we're still kind of leaving behind this March 11th, 12th turnaround. We have again that same sort of bounce up and then a new bounce a little bit higher above the 20 and the 50. If we pull back, it's that same convergence, the 50, the 20, and that March 11th price zone, which is going to be critical as far as the level of support is concerned. And a lot like the S&P 500, that might set up that possible head and shoulders that we could see developing. So it's basically a mirror of what the S&P 500 is doing. However, relatively speaking, a bit weaker than the S&P 500. If we look at the long-term chart, you can see that we're not really anywhere close to the ceiling of the price action from 2018 to 2019. We're kind of in the middle of that range. So it shows that the Dow Jones and its components have been, relatively speaking, weaker. Keep in mind they have stuff like Caterpillar and Boeing, which are not going to do nearly as well as Amazon and Netflix. So you're going to see a difference here, and that's what the difference is. The Dow Jones, the industrial components of it's the Dow Jones Industrial Average, right? So a lot of its components have actually been hit harder by our current economic situation, and because of that, you can see the relative weakness. Now, that being said, in the short term, they've recovered fine, and they're kind of doing the same thing as the S&P 500, just at a lower relative level. And a lot of what I said about the S&P 500 stands for the Dow Jones. We want to see support here in the short term around 233. If we fall below that, again, that's not a good sign, because it means that we're going to probably come back and start testing some of these lower levels. And it also means we're back below that price point when the NBA shut down and when a lot of the rest of the economy kind of followed suit. So we want to stay above that and show that we're still kind of recovering and anticipating a return back to normalcy in the economy. Resistance is way out of here at 265, around the 200. That's not something we need to really concern ourselves with. I think if we're worried about resistance in the markets, that's where the S&P 500 and the NASDAQ are, and to a certain extent where IWM will be. So I think that's more of an interest for me than looking for resistance on the Dow Jones. I think the Dow Jones has plenty of room here to try to catch up before it hits a major level of resistance. And if we're looking for where the market's going to roll over, I think the levels on the S&P 500 and NASDAQ are more relevant than this area here on the Dow Jones. Other than that, there's not much more I want to add. Like I said, a lot of what the S&P 500 and NASDAQ are doing are the same as the Dow Jones. So a lot of that analysis basically stands for this. Now, the last one we want to look at is IWM. And this one, of course, is the most different of all of them. The small caps have tended to be, relatively speaking, the weakest of the four major indices. And we've actually seen a lot of strength recently. And there's two possible interpretations of this. One is that traders are starting to accept risk again. And that's usually what you see when the small caps are leading a market upwards, because IWM has the most risky assets as far as the four major indices are concerned. And it's the one that typically will lead the way in a very bullish environment where traders are more concerned with rewards rather than risk. However, there is another interpretation, which often happens at the end of rallies, which is traders are looking to squeeze as much as they can out of a market, and sometimes the weakest names are the ones that rally last, because they're the only ones that are left for people to pile onto. And I don't know which of the two is the case here. It's not really something you can figure out at real time, and sometimes only becomes really relevant or evident in hindsight. So we won't really know for sure until we pull back what exactly is happening here. But right now, as you can see, IWM is up 5%, while the other indices are up 2 or 3, and that's been the case for the last 3 days. Now, unlike the other indices, if we go back and take a look, you can see the S&P 500 had this rising channel. Give me a second. Alright, so we had this rising channel, and then we have another rising channel, showing that basically it wasn't consolidating in a healthy manner. It's consolidating in a way that squeezes upwards, right? The NASDAQ had the same thing. We have these rising wedges. The Dow Jones, while it has sort of the same picture, did spend a healthy time consolidating sideways and printed what could be a nice little bull flag. Well, IWM, as you can see, actually had a normal, healthy consolidation. They had a nice little wedge here. You had volatility contracting before the big move upwards, and as a result, they've had the healthiest breakout. Now, they have reached a pretty critical level of resistance. We've also left behind that March 11, March 12 turnaround. A pullback to that level would be basically the same as the other three indices, in that it would come back and test the 50, possibly the 20, and that level. So, IWM has made a nice comeback and has made up a little bit of ground. However, we look at the long-term strength here. You can see IWM has been, relatively speaking, very weak. As you can see, actually still below almost all the price action from 2018 to 2019 and even through 2020, right? So, still a lot to make up here. But there's been a nice shift. And so the question now becomes, like I said, is this because traders are getting more aggressive? and think that this is that we're done? Or is it because traders are buying the stocks that haven't gone up yet because they're trying to get as much return as they can out of this rally, right? And we don't know, of course. We'll find out soon enough. But one thing I've noticed is there's a lot of stocks bouncing now that I don't consider, and these maybe aren't necessarily components of the Russell 2000, but I think illustrates the point I'm trying to make of stocks that have been beaten down to a pulp, basically. And they're starting to rally because of this anticipation of us opening up. Stuff like cruise lines. You look at Carnival Cruise Lines and what they've done just over the last 3 days. You look at Norwegian Cruise Lines. You look at maybe a movie theater like AMC. And what you'll see is these stocks that really have no reason to rally are starting to rally because they're hoping they're going to finally open. Now, the case could be made, even once we open, are people really going to be bold enough to start taking cruises again or go back to the movies? And if so, if they're not, are these rallies a little bit getting a little bit ahead of themselves? Or is this really reflective of what their new price level is, right? So what I've noticed is that there's a lot of stocks starting to rally, and I think IWM is an example of this sort of thing where a lot of the stocks have been beaten down and haven't had a chance to rally are finally starting to rally. And again, that could be one of two signals. That could be the end of this bounce that we're seeing, or it could be the beginning of a shift back to riskier assets because people think that we are ready to return back to normal. And like I said, I think that we'll get a much clearer picture over the next week as we go through whatever, we digest whatever's going to happen with FOMC today. We digest what's going to happen with the next couple of earnings. Keep in mind, I said Amazon and Apple and Facebook, all those names report, but this is the busiest week, and there are hundreds of reports this week, and there's going to be a lot more. Visa, MasterCard reported yesterday, Visa reports, so tomorrow I think, and so there's a lot of names reporting here that are going to really give us a better indication of where our economy is, and so the market is going to definitely give us a better clue over the next week, especially as we roll into a new month, and see whether this was window dressing at the end of April, just to kind of get the month at a nice close. So we'll see what happens. And like I said, I think what's important here is how do we respond once we do pull back? This is a very big shift. Regardless of whatever the reason you attribute to this bounce, the fact of the matter is that it is a bounce, and it's a very strong bounce. And technically speaking, it's a very big change in character for IWM to go from a sideways trajectory back upwards. Now, again, we've got this gap here. This is a pretty critical gap to fill. And like the S&P 500 and like the NASDAQ, we find ourselves at a pretty strong level of resistance on IWM. And so the question is, are we going to be able to push through all these levels of resistance and start making our way back up to levels that we found ourselves late last year and early this year? Or are we going to finally find resistance and come back and establish a new normal for the market that maybe isn't as high as our recent highs, but isn't as low as our recent lows, and we could just sort of build sideways. And my thinking is that we probably need to do that more than make our way back to highs, but you know, it'll be a little bit more evident for us once we see what happens next with these levels of resistance. I personally think that we are probably going to roll over soon. Now, this is a very strong bullish pattern, and typically resolves in a bull flag, not a total roll right back down to lows. So ideally with IWM, what we'll see is just a drift back to the 50-pair moving average, and then another attempt at this gap, or maybe we fill this gap before we roll over if we have a quick reaction upwards on FOMC today. Keep in mind, like I said, we have an FOMC statement in about an hour. That tends to have a pretty strong impact on the market in the short term. Not always in the long term, but very often, at least for the first hour, there's some pretty wild shifts in the market, and that's going to definitely impact the market today. And the question will be, again, you don't want to jump to conclusions with the FOMC statement, because a lot of times it will shoot up in one direction, then shoot down, or vice versa, and then do it 2 or 3 times before it really figures out where it wants to go. And many times you don't really figure out till the end of the day or the start of the next day, once people really digest whatever the FOMC is trying to say. So keep that in mind, because that could have an impact on how we move forward, and definitely will have an impact on today's price action. And if there's a strong surge upwards, maybe we fill that gap today, although I don't think we will. But if we do, then either way, I still think that that's a strong level of resistance. And like the S&P 500 and the NASDAQ and the Dow Jones, I like what I'm seeing here. I think that we're seeing very bullish price action, but I don't think that this is a good trading opportunity. And because of that, I'm not focused on buying long this week. For those of you that have followed me consistently over the past, you'll know that what I've been focusing on this week is earnings trades because they're not correlated with the market right now. We had a very good trade on Netflix last week, and we had a good trade on StarBucks this yesterday, where we were looking for it to not move, to basically stay inside of a range, and it basically did that. One of the nice things about the market right now is because of the drastic drop that we've had and the volatility we've had. There's been, the VIX is up quite a bit, and premium is pretty elevated on options right now. And what I found is that more than normal, this quarter has actually been a good one for selling volatility as far as earnings events are concerned. And that's worked out pretty well. I've seen a lot of names that have inflated volatility or inflated premium that's well above what these names normally do during their earnings reports, and it's worked out well for me, and I've been able to kind of take advantage of that. And I like that because it's keeping me away from trying to guess what the next direction on the market is, because again, we're in a market that's trying to trade upwards, despite the fact that it's already moved up so strongly. And like I said, the risk reward just isn't here. But at the same time, while the risk reward is here for a short, the price action isn't ready for a short yet. And so because of that, it's kept directional trades kind of off the table for people that are looking to kind of play it. And in the end, what we've really gotten is a market that is trying to trap traders by forcing them to chase price action or to get names that maybe they don't believe in, right? For instance, I saw developing longs on the cruise lines, but I didn't want to take them because I don't trust these names right now. And you might say, well, yeah, but a long trade's a long trade. But we're not in a market that's easy to trade. And I think at this point, what we want to do is make sure that we're careful and we wait for better opportunities. You don't need to force the price action here. This was actually a pretty clean trade, but I didn't want to trust it because, in my mind, these cruise lines, any night that we have bad news, could turn around and you have a gap lower. So despite the fact that this is a good move, it's on an area of the market that I suspect is not going to do well over the course of the next 5-6 months. And so despite the short-term strength, I'm not interested in buying this. I'm more interested in trading the names that I've traded long over the last month or so, and that's what I'm going to focus on. Yanni, you're asking if I trade shares or options. I do both. I trade shares whenever I'm swing trading. Options when I'm doing any kind of trade that involves premium selling. I'll trade Forex if it suits me. I'll trade futures if they suit me. I've found, generally speaking, that if I could read a chart, then I could trade any instrument. So I kind of try to stay diverse. I'll trade Bitcoin and other cryptocurrencies. Generally, as long as I could read the price action, I'm fine. So I'm pretty diverse when it comes to that. I find that having as many instruments that you could trade as possible is going to help you in the long run, because you could do stuff like what I'm doing, right? If I don't like what the market's doing, then I could kind of shift and start looking at earnings trades instead, right? Or if I don't like, if we're not in earnings season, then I could shift back into that. Or if I don't like what the market's doing on a long-term basis, I could just day trade. And so as long as I can kind of shift back and forth, then it makes it a little easier for me. All right, so that's the four major markets. Like I said, right now, the market's bullish, but I'm not excited about it because I don't think that the risk reward is there. And I know some, you're new, and there's a couple of viewers here that are probably new as well. Over the last month, I have a blog. It's on patreon.com/StockDarts. I'll type it on here. And some of the stuff is subscription, but a lot of articles are free, and even a lot of the subscription articles go free after a few days. And I outlined a strategy earlier in March, really, of what I wanted to trade and what I didn't want to trade. And my focus was to trade long names like Amazon, Zoom, Netflix, Citrix, names that benefited from the type of environment that we're in, where people are relegated to work from home. And then it was to avoid names that I thought were going to be punished severely by being locked down. Stuff like airlines, oil names, and that's still my goal, right? But right now, the risk reward isn't there for the long names. It's starting to get there for the short names, And what we need now is for the market to roll over, at which point some of those names I think are going to be good shorts again. So where I stand right now is I'm waiting for the market to reveal what the next move is. We've hit a lot of strong levels of resistance, but we're not really rolling over yet. So I'm waiting to see exactly how that plays out. And when we do roll over, I will take some shorts, but I will also be waiting to see if we just get a shallow pullback and if in reality that bullishness that we have underneath the surface persists longer. So we're kind of at a turning point here, but my general thinking is that this market is probably going to be more range bound. I don't think that we're going to make our way back to new highs. I don't think we're there, and I don't think we're supposed to be there. So when we do roll over, I'm going to start, to me what we're doing right now is identifying what range we're in. And I think at the moment we're starting to establish whatever the ceiling of our current range is. I think the floor has hopefully been established as well. Now it's a matter of establishing the ceiling, and then once we have that, we'll have a new parameter where we can figure out what the ceiling and what the floor is and how we trade in between those levels. And I feel like that's what we're kind of establishing at the moment. And we're getting very close to what I consider to be the ceiling. So now it's a matter of seeing when we do find that ceiling and how we react to that, and whether we come all the way back to the floor or whether we just come back and retrace some of these shorter term levels of support. So, overall I think we're in a good place. We're not in a bad place right now. We're in a much better place than we were a month ago. And we'll see how we react once we do find selling pressure. Because there will be more selling pressure. I don't think that all the bad news is out of the way yet. All right, let's take a quick look at the US dollar. As you can see, the US dollar has contracted quite a bit. Now again, we have an FOMC statement today. The dollar will react strongly to whatever they say regarding interest rates, whether they're looking at lowering them again or raising them. Obviously, they're not going to raise them, but depending on what they say, that could impact the US dollar. It could impact gold and silver. So we want to see how they react. As you can see, the dollar has lost or contracted a lot as far as volatility is concerned, which I think is a very good thing. If we look at the individual currency crosses that I like to look at, we'll see a little bit of a different picture with the US dollar versus the euro. And again, this is a chart of the euro. So up is good for the euro and down is good for the US dollar. You can see the US dollar is making strides against the euro and is looking to, at the moment it's actually kind of stabling, basing out and having kind of a little bit of a price stabilization. But if it continues this trend, we can see it had this volatility contracting that we broke down. If it rolls right back over, that's good for the US dollar. That shows the US dollar is gaining strength. However, if the euro rallies back into this 109 area, then it shows again that basically we're just seeing prices flatten out here, or the trade flatten out. And these stocks are kind of trading at an equilibrium, or these currencies. Right now, this I think still favors the dollar a little bit, but not by much. If we look at the U.S. versus the yen, we'll see the dollar losing some strength here, losing a pretty critical level. But again, the big key is that we're starting to see volatility contract, and even when we start to see these moves, volatility expand in the short term, in the long term, we're still getting price to quiet down a bit. But again, this is a little bit bearish for the U.S. dollar as it rolls right back over. We'll see how far it goes. I don't expect too much more downside, but a lot is going to depend on what we see with FOMC. And then finally, we have the U.S. versus the Canadian. And in this case, we actually have, again, what is a pretty strong dollar, but it actually has started to struggle a bit as the Canadian has kind of stabilized. And this one is going to be affected a lot by oil price. And at the moment, oil is finally starting to stabilize, at least for now. And that is causing the Canadian dollar to stabilize and push and exert a little bit of pressure on the U.S. dollar. Now, that being said, I think that this is a good floor here around 138 for the U.S. dollar. And I'd expect it to stabilize and turn right back around. So for those of you that are into trading Forex pairs, this is probably the easiest one to read the price action on. Again, we're not there yet, but I would expect a reversal pattern soon on the U.S. dollar, unless for some reason we get a big move on oil, which I don't expect. Now, the oil chart's going to be broken for a while here. This end of month move, really, I mean, this chart is almost useless to me right now. If we go down to maybe a 30-minute chart and look at the price action over the last week, we could see oil has been range bound, right? Basically trading between about $10 and about $18. and it's starting to make its way back up there. So we're seeing some recovery here, but it's going to depend on when this contract expires and on whether people are willing to take delivery on oil again. I think again, I'm very shocked that the market didn't react poorly to oil trading at a negative last week, and I think more than anything is really shows us just how much our economy has slowed down. And until we open up our doors and until we start to see people come back out to work and travel, oil's still going to struggle a lot. And we'll see what happens in the near future. But for now, this continues to be an instrument that is very difficult to really gauge. And I think I'm still pretty bearish on it until we see more signs of our economy strengthen. A lot of people have been looking to buy USO only because it's cheap. And as you can see, it continues to struggle. So you'll notice the price here, $18, right? USO was at $2, I think, just yesterday. We had a reverse split, which is probably good for USO. But generally speaking, as you can see, it's struggling here. It just continues to drop. And I think at the moment, it's actually not a good instrument. If you want to play an oil bounce, I don't think USO is the instrument to trade right now because of the risk that's entailed in it. It's actually had to shift its structure and start using more back month contracts instead of just the front month in order to insulate itself from another possible scenario like we saw that super contango drop that we saw during the last week or so. And we don't want the same scenario to happen, and USO doesn't want to be closed down like a lot of other oil ETFs had to close down. So they've shifted the structure, and I think at the moment the jury's still out on exactly how it's going to behave and how it's going to mimic oil moving forward. So I'm actually not interested at all in trading this. If you want to trade an oil bounce, you should probably look at just trading the gas names like the big major, Exxon, Chevron, stuff like that. Or look at individual oil names that you think maybe will benefit once we do open up our economy a little bit. Oil tankers, like we mentioned last week, have been okay because, again, they're the ones that are holding all this oil and have gotten it cheaper than normal and will likely eventually end up selling it for higher prices. But, that's already been factored into their price. And so they've been trading pretty well. We're seeing a little bit of a drop here on, say, something like that, like TK here, but generally speaking, these tankers are the ones that are holding a lot of the oil now. And if you wanted to play a bounce on them, you could play the range once it comes back and maybe gets back into this channel that it's trading in towards the bottom of it. You could maybe play something like that, right? And I would be more inclined to do something like that than looking at USO. Now, again, my focus right now isn't trading oil long because, like I said, if you go back and read my thesis for the last month, my idea has been I want to go long stuff like Amazon. I want to go long stuff like Zoom. I want to go long stuff like TDOC, right? I don't want to go long oil names. I don't want to go long cruise lines. And even if they bounce, those aren't the names that I trust. And those are the names that I feel have the most overnight risk with bad news, right? And these names are the ones I feel have the best overnight news risk as far as how they're going to react to the market and how they're reacting to the current situation we're in, because they benefit from us kind of being locked at home, right? We've done a lot of these. We've gone over a lot of these over the course of the last month and a half now. Even stuff like American Tower, I think is a good safer name for you as far as a dividend stock that benefits. These guys own cell towers. It's a REIT, but it's a REIT that owns cell towers, not commercial businesses or commercial realty. So they're holding up well. You have stuff like Equinix, which is another REIT, but they hold data centers, and they've actually done fine because, again, they're not in a sector of the market that's struggling right now with being quarantined and with being self-isolated and with people not out there shopping. And so they've done fine. So I'm more inclined to continue looking at these names, even if they're at highs. The risk reward's not there right now. But I'd rather wait for these names to come at support than try to take shots at long trades on names that I think are more likely than not to turn lower if we get any kind of whiff of bad news and decide that we're not ready to open up our markets. Okay? Now, Let's look at gold and silver real quick, and then we'll move on to the chart requests. We have a decent amount of viewers as far as my normal goes. If anybody in here again has a chart you want me to look at, feel free to type it in, and we'll go ahead and take a look at it. Now again, gold and silver are going to be affected by whatever the FOMC statement is. They tend to fluctuate quite a bit during FOMC days, reflecting basically the opposite of whatever the dollar is doing. And I think at the moment you can see GLD has come back to a pretty decent level of support, or is very close to it. And we have two conflicting patterns, right? On the one side, we have this nice little pullback. Right? Which is a bullish pattern, right? You have a breakout, and then you come back, retest, you come back. Now the problem is this is also a possible double top, right? Now it's not a confirmed double top because we haven't had the breakdown, but we do have what could be a possible double top, right? Now, for those of you that are wondering why I'm saying that, a double top doesn't actually occur until we get the breakdown below the neckline. Okay, and the neckline's actually down here, probably around 157. If we do get a break below that, then that's a bearish move for gold, and likely means that it needs to come back down and test down here in the lower 150s. However, if it just responds off of this pennant that it's forming, then we're going to get another move back up and likely test its highs. Now, I will continue to stay away from GLD and from gold. It's not a trade that I'm interested in at the moment. I will admit that I missed out on a nice move upwards on it. But it's not a pattern that I'm comfortable with trading right now. And like I said, I don't think that we're in a point in the market where we want to push our luck, right? So I'm going to go back to the S&P 500 real quick. And we're going to look at a longer term chart. And we're actually going to look at a monthly chart just to get a better idea of where the market has been over the last decade, right? Since we had the real estate bubble and that big crash in 2008. There are good times and bad times to trade the market. And at the moment, we're in a bad time, right? You have these situations like what we had in 2009, basically 2010 to 2011, where the market climbs uninterrupted, right? And more importantly, what we had back in 2013, where the market just slowly climbs upwards, just keeps climbing, doesn't have a pullback. All pullbacks are bought. These are the easy points to trade. These are the types of environments where you want to be aggressive because the market actually erases mistakes and takes care of traders by basically continuing to climb upwards. Those are the times where you want to push your luck and you want to be more aggressive with trades. Now, you still want to be disciplined because what always happens is traders start to get undisciplined and then they get punished when the market turns around and becomes more difficult. And when the market's trading sideways, especially at the beginning of that turn, it's a very difficult market to trade because you have traders that have gotten accustomed to one type of price action and then it shifts. Now, when a market is completely range bound, it's not quite as difficult, but it's definitely still difficult. And then eventually, you'll have another strong trend and the market becomes easy to trade. And then as it shifts back to neutral, you get these really difficult moments to trade, right? Now, earlier this year, we had what was a pretty easy market because it was just climbing steadily upwards and refused to drop for anything. Once we had that drop, we've reached a point now where we have a market that's very difficult to trade. We have a market that's in transition. We have a market that's in flux and is going back and forth and trying to figure out what it's supposed to do next. And these are the types of environments that really punish traders. Mistakes are often exacerbated and punished heavily. And traders that chase, in particular, usually get punished because the market is shifting back and forth as it tries to figure out what it wants to do and what it's supposed to find as far as value is concerned. And that's where we are right now. Now, does that mean you shouldn't trade? No. A lot of times you still want to, especially if your income depends on it, or if you are, your long-term accounts, you still want to hold stocks through this. You want to be able to manage yourself through them, but you don't want to be aggressive. This is not where you want to take chances. This is where you want to make sure that you're taking the trades that you believe in and the trades that are really beneficial to you, that give you good risk reward or high probability of success. This isn't where you want to be pushing your cards and taking, shots at bottom fishing just because there's a chance that a weak stock is going to bounce. This is where you want to make sure you're trading strong stocks and you're trading them and you're dictating the terms of where you want to enter and exit. You're not letting the market tell you what it's supposed to do, right? So you want to be in control of the trade setups that you are comfortable with, and not just reacting to what the market's doing and trying to chase what the market's doing. So because of that, despite the fact that gold and silver, as gold in particular, has given a decent long move, I haven't been involved because it's not an area that I felt was enough probability for me to trade. You'll notice silver is lagging quite a bit behind GLD. Now, that being said, it's trading in a much more contracted state and is broadcasting what is an easier trade for someone that wants to go short or long. Because at this point, risk reward is in a good spot either way, right? If you want to trade the breakout to maybe 1480, well, you have a good tight range. And if you want to trade the breakdown, you have the tight range as well. But again, it's not an area that I'm focused on because I feel like I have cleaner trades in other areas. I feel like I have a very well-established track record with earnings trades, and I have a very good track record as far as trading the tech names, and the trading plan that I had in place for this coronavirus situation has worked out very well for me the last couple of months. So I don't have to push myself by trying to get a trade on silver or gold if I don't want. So I've been avoiding them. I'm not saying you need to avoid them if you have a good read on them or you're trying to figure out what you want to do next. But I think we'll get a clear picture on them when we see what FOMC does. And from there, it might be a trade that you want to take. But me personally, I'm not at the moment inclined to take them because I feel like gold is leading the way, not silver. And gold has been in a very sloppy trade. There's been a lot of volatile consolidation, and this tends to be a trade that has a lot of fake outs. And so it's not an easy trade to take. And so because of that, I've kind of stayed away from it. Okay? All right, Yanni, so how do I trade earnings reports? All right, so I actually used to have a workshop that I would have every quarter where I would basically, we'd have an educational session where I'd teach people how I trade earnings, and then I'd trade for the next 4 weeks and have them kind of follow along on some of the trades. Now, it wouldn't be a service where I tell you buy this and sell this. It'd be more along the lines of where we'd go over maybe 10 to 12 names each week, and I'd highlight the 3 or 4 that I like the best and which ones I'm taking. But I still would kind of encourage traders to make their trades rather than just copy me and say you're entering at this time, you're exiting at this time, because that's basically what I feel helps you teach you better. But to give you a synopsis of how it's done, there's a few ways of trading earnings reports. Generally speaking, my favorite way to trade is I will look at a stock and I will price the volatility on it, and I'll try to decide, is this stock over or underpriced as far as what the options are pricing in. And if it's underpriced, then I'll go ahead and buy volatility and expect to move outside of the range. So to go back, we're going to take a look. I'll go ahead and outline 2 different plays I've taken over the last couple weeks. One is on NFLX, which reported earnings last week, right? You can see the earnings date was the 21st, right? So what I did was on the 21st, right? I think it was the 22nd. No, 21st. Okay, so on the 21st, what I ended up doing was I went ahead and analyzed the stock, and I tried to figure out what's being priced in. And Netflix was pricing in, if I remember correctly, volatility of like 13%, right? And so I have to make a decision. Do I think Netflix is going to move more than 13% over the next couple of days? I'm using weekly options for this. Okay, and my feeling was that Netflix earnings, there was too much volatility being put into this because of the move up to begin with, and because of the overall environment that we're in as far as an elevated VIX. So I sold the volatility. What I did was I basically took a calendar spread expecting Netflix to stay stuck in a range, and it did. I took the 440 calendar spread, so it wasn't actually that, I think it was 440, and even though Netflix was trading down here in the 420s, I was still able to get a very healthy return off of it, well over 100%, because it traded within the range that I expected. And so that's what I typically do, is I'll put it in play where I expect the stock to stay stuck in a range, and then I'll do that. So the other one is SBUX, which is of course still in play right now. And it was the same basic idea. So when I look at SBUX, and it had about a 5.5% return, a 5.5% expected volatility. And I look at what Starbucks typically does. Starbucks typically during earnings moves maybe 2 or 3%. Now, okay, so you're asking Iron Condor. The two basic trades I take when I'm selling volatility is either an Iron Condor or a calendar spread. More often than not, it's the Iron Condor. However, with the elevated volatility that I've seen this quarter, I've found better risk rewards so far on calendars over Iron Condors. But yes, Iron Condors. Generally speaking, Iron Condor is the play, right? So like in this case, this white box here is what the options were priced in on Starbucks. You can see that's a pretty wide range, right? So basically, in this case, I took another calendar spread, not an Iron Condor, but basically it's the same idea. I make a play expecting Starbucks to either stay in this range or break outside of that range. So I'm not playing it directionally. I'm playing basically either expecting it to stay in a range or break outside of a range. And as you can see, Starbucks had a very, very low volatility move. And at the moment is actually giving me, again, a lot of profit because it's staying, not only is it staying within that parameter, it's staying decently close to the middle of it, which is giving me more for the calendar. Now, with an Iron Condor, it wouldn't matter. It would just matter as long as it stays within those parameters. Now, the opposite end of that is, of course, you could take the opposite of an Iron Condor, right? Instead of taking one with credit, you could look at a debit, and you basically you do the opposite, and you look for it to move outside of those edges. And so, in some cases, if you see a stock that sometimes if Netflix was had a move priced in of maybe 7-8%, then I would have bought volatility because I would have expected a double-digit move, hopefully. And so that's how I play. That's how I play earnings for the most part. Now that being said, a lot of people aren't comfortable with options. So you'll notice if you go to that Patreon link that I put, this week I put up basically maybe 5 or 6 stocks that I'm looking at. But instead of outlining options trades for it, I just put levels that I think are important. Because if you're not comfortable with options, you can always trade earnings after the fact. You could do a post earnings trade based off of what it's going to do now. One of the trades I mentioned was maybe Google, and the potential scenario on Google was if it reported a bad earnings and came down to support, I would have looked to play it to the long side. If it had a kind of a mediocre move and then came back and retested this, I would have played it off of this. But of the scenarios that I outlined, none of them were looking for a move up. Now, the most likely move for Google was up, but that was not the move that I was looking for because that would be the trade that would be the hardest to trade. So basically, you can always outline a potential scenario that you have in mind, and then if it happens, it happens. If it doesn't, then you didn't get a trade, right? And so what I'll do with post-earnings moves often is I'll look at a name that's strong, and I'll look to buy a dip. Even though the more likely scenario is that it's going to go up, it won't be the trade that I'm looking for. What I'll look to do is buy a dip on a strong name or sell or fade a move up on a weak name. And so in this particular case, the trades that I outlined didn't play out, but that's fine because there's other names that I could look at, and we'll look at it again. Like I'll look at Amazon and Apple and Facebook and see what they do, and have plays outlined for them. And the only time I'll take them is if they work in my favor. But that's another way of playing on earnings, right? So that's the thing. There's a lot of diversity on how you could approach and trade earnings. You can either trade into the earnings report, you could trade through the earnings report, or you could trade after. And a lot of times people think, well, I'm not going to trade earnings because I'm not comfortable with options. But the fact of the matter is you don't need options to trade after earnings, right? And, a lot of times that initial move after earnings is not going to be correlated to the overall market. So for people that like to day trade, they can still trade an earnings report. Just wait for the report to finish. Then there's a lot less uncertainty. And it's a lot easier for you to gauge what the price levels are that are important. And more than anything, you're going to have movement that day because more often than not, one thing earnings trades bring is they bring volume and they bring volatility. So if you don't like options, you can always trade them after. But as far as me personally, like you were asking, how do I trade reports? I prefer to trade it by trading volatility. I will either buy it if I think it's underpriced, or I will sell it if I think it's overpriced. Okay. And if you have more, if you have more interest in that, you can always email me or message me, and I can, we can always set up a mentoring session or something along those lines, and I'll give you more information, or you could just follow it up. Okay. Okay. Well, I mean, that was what I used to do. The thing is, I've had a pretty significant change in where I post trades and all that. It's a long story, and so I kind of stopped doing those mentoring, the group workshops. But I still teach individually if people are still looking to learn. So if you're looking to take an options class, if you want to learn options, I can work. I can teach you options. Now, I know some people don't want to pay for that. If you feel like you're not comfortable yet with that, you could just keep following me on these Wednesday webinars. You could look at my posts, and as you get a bigger comfort level, maybe you'd be, then if you're more comfortable with it, you can. But that's what I used to do. Is I would spend basically a 2 to 2.5 hour session teaching people how to use options, and then from there we would take options trades, and you learn by practicing, of course, and that's how I would teach. Now I don't have the same customers as I used to. I don't have as many people following me as I used to, so that's kind of been an issue. But if you want to take that class, you can always take it one-on-one. Okay. All right. Well, I think we've run through the hour. We didn't get any chart requests, but hopefully this was informative for those of you that are into options or into trading earnings. Keep following me on Twitter. That's usually where I post stuff. Anyone else that's in here, if you have a chart request or had one and maybe weren't comfortable asking for it in public, you can always message me on Twitter. I could DM it to you. You can email me, stockdarts@gmail.com, and I'll be more than happy to send it to you that way. And more than happy to just help people with any questions they might have. Other than that, I hope you guys have a good rest of this week, and we will meet again next Wednesday.